Every month, millions of people do what they were told is responsible. They work, they save, they leave money in the bank, and they feel safe. That is the trap, because your money does not need to disappear overnight to be destroyed. It can die slowly, quietly, legally, respectably. No thief has to break into your house. No hacker has to drain your account. No market crash has to wipe you out. Your cash can lose strength while sitting exactly where you were told it would be protected. You look at your bank balance and think nothing changed, but life changed. Prices changed, rent changed, food changed, energy changed, the cost of surviving changed, and that is how the illusion works. The number stays still, so you feel calm, but the purchasing power underneath that number is quietly bleeding out. So if you feel like you are doing everything right and still falling behind, this may be why. Because the bank is not always stealing your money in dollars. It is often draining it in power. Warren Buffett once said, "Price is what you pay, value is what you get." And if your money is sitting still while prices keep moving, you are paying more every year for the illusion that you are preserving value. This is not just a video about savings. This is a video about silent financial death. This is why your money is dying in the bank. The inflation trap. To understand this trap, you have to understand why the bank feels so emotionally untouchable. For most people, the bank is not just a financial institution. It is a symbol, a vault, a shield, a place your parents trusted, a place your salary lands, a place that makes adulthood feel organized. You were taught that reckless people spend, smart people save, and disciplined people leave cash in the bank. That lesson is not completely wrong, it is just incomplete. Because there is a difference between storage and strategy. There is a difference between liquidity and wealth. There is a difference between having money and preserving purchasing power. Some cash matters, emergency cash matters, short-term reserves matter. You do need money that is safe, accessible, and ready when life hits you in the mouth. But somewhere along the way, millions of people turned an emergency tool into a life strategy. They did not just keep 3 months of expenses there. They kept their future there, their hope there, their delayed freedom there. And that is where the damage begins. Because cash in the bank can protect you from chaos this month, while quietly guaranteeing weakness over the next 10 years if it is your only move. Benjamin Franklin warned, "Beware of little expenses. A small leak will sink a great ship." Inflation is that leak, small enough to ignore, relentless enough to ruin you. You do not feel it like an explosion. You feel it like erosion. Not dramatic enough to panic you, just steady enough to keep you poor. And this is why most people never notice the trap until it has already stolen years from them. Here is the core principle. If your money grows slower than the cost of life, your money is shrinking in real terms. That is the whole game. People get hypnotized by nominal numbers. They open the app. They see the same balance. Sometimes they even see a little interest, and they feel relief. But the number is not the truth. The number is only the surface. The real question is this: what can that money still buy? If prices rise faster than your savings grow, then your cash is not holding value. It is surrendering value. That is how money dies in the bank. Not through disappearance, through dilution. If your cash earns less than inflation, you are not compounding. You are decaying more slowly than panic. And once you understand that, you stop asking the wrong question. You stop asking, "Is my money safe?" and start asking, "Is my purchasing power surviving?" That shift changes everything. Because wealth is not measured by how calm your account looks. Wealth is measured by how much future freedom your money can still command. Charlie Munger said, "The first rule of compounding is to never interrupt it unnecessarily." But inflation interrupts compounding for people who never enter the game. It punishes stillness. It taxes passivity. It destroys savers who confuse inactivity with prudence. You can save for years and still end up weaker. You can be disciplined and still fall behind. You can be responsible and still lose. Because discipline without strategy is just slow-motion obedience. That is the snowball most people never build, not because they lack effort, but because they put their capital in a place where time does not help them enough. Most people do not lose to inflation because they are stupid. They lose because the trap is psychological. Trap 1. The safety illusion. The bank feels safe because the balance does not swing every day. No red candles, no scary volatility, no emotional pain. But volatility is not the only form of risk. Invisible erosion is risk too. A quiet loss is still a loss. Trap 2. The nominal money trap. People think in dollar amounts, not in real purchasing power. If your account says $10,000, you feel stable. But if prices keep rising faster than your yield, that $10,000 is becoming a smaller weapon against reality every single year. Trap 3. The obedience trap. This one is the darkest. The income system trains you to earn, save, and repeat, not to own, not to allocate, not to build. So you work harder, you store more cash, you feel more responsible, and you remain financially fragile because the machine taught you preservation without teaching you multiplication. This is why so many disciplined people still feel stuck. They are not reckless. They are obedient to a weak playbook. Ray Dalio said, "Cash is trash." That line sounds extreme until you realize what he meant. Cash can be useful for survival, flexibility, and optionality, but as a long-term wealth strategy, it can become a guaranteed surrender to inflation. You do not need to hate cash. You need to stop worshiping it. And that is the emotional trick of the bank trap. It makes weakness feel mature. It makes passivity feel wise. It makes stillness feel responsible. But if your money is not moving intelligently, time is not protecting you. Time is working against you. So what are the rules? If you do not want your money to die in the bank, what do you actually do? Rule 1. Separate emergency money from investment money. Keep cash for shocks. Do not keep your entire future in cash. Rule 2. Measure in real returns, not nominal comfort. A small yield means nothing if the cost of life rises faster. Your money must outrun erosion, not simply sit politely. Rule 3. Use the bank for liquidity, not for long-term compounding. The bank is often a parking lot. It is not always an engine. Rule 4. Build ownership. Assets, productive businesses, quality equities, cash-flowing systems, or other inflation-aware vehicles matter because they can rise, adapt, or throw off returns while cash sits still. Rule 5. Upgrade from saver psychology to allocator psychology. A saver asks, how do I protect this? An allocator asks, where does this survive and grow best? Rule 6. Respect liquidity, but price the cost of over-liquidity. Convenience has a hidden fee. If instant access becomes your highest value, long-term decay often becomes the price. Rule 7. Know the difference between no volatility and no risk. A flat balance can hide a shrinking future. Peter Lynch said, know what you own and know why you own it. That applies to cash too. If you keep money in the bank, you should know exactly why it is there, how long it is there, and what job it is doing. If the answer is just habit, the trap already owns you. And this is the rule most people need to hear. Saving is not the finish line. Saving is step 1. Step 2 is allocation. Step 3 is compounding. Step 4 is ownership. If you stop at step 1, you do not build wealth. You only delay collapse a little longer. Here is the paradox. The answer is not to put every dollar into risk assets. The answer is not to declare war on cash. The answer is not to become reckless because inflation exists. In fact, you do need accessible reserves for emergencies, loss of income, repairs, medical bills, and financial shocks. Cash has a role, safety has a role, liquidity has a role. So the paradox is this: money in the bank is smart for survival, but dangerous as a substitute for a real wealth plan. That is the nuance most people never hear, because the internet will tell you one of two lazy stories. Either cash is king or cash is useless. Both are incomplete. Cash is a tool, and tools become traps when used for the wrong mission. Your emergency fund should sleep. Your long-term capital should not. Morgan Housel wrote, Every bit of savings is like taking a point in the future that would have been owned by someone else and giving it back to yourself. That only works if your savings still hold power when the future arrives. If not, then what you thought was protection was just delayed weakening. That is why poor strategy often hides behind responsible behavior. You feel mature, you feel patient, you feel in control. But if inflation is eating your future faster than your system can rebuild it, then what looks calm on the surface is chaos underneath. And that is the cold truth. The bank can protect your access to money while failing to protect the life that money is supposed to buy. So here are the 8 iron rules of the inflation trap. 1. Cash is for stability, not for your entire future. 2. If yield is below inflation, your money is losing power. 3. A stable number can hide an unstable reality. 4. The bank can store money, but it cannot automatically preserve wealth. 5. Emergency funds belong in safe, accessible places. Long-term capital needs a real plan. 6. You do not escape poverty by saving only. You escape by owning, allocating, and compounding. 7. Real wealth is measured in future purchasing power, not account screenshots. 8. If your money is not working, inflation is. That last rule is the one you should remember, because inflation never sleeps. It does not care that you are responsible. It does not reward you for feeling cautious. It does not pause because your cash is in a respectable institution. It keeps moving. And if your capital does not move intelligently with it, your life gets more expensive while your strategy stays emotionally comfortable. That is how people spend 10 years doing the safe thing and wake up shocked that safety never turned into freedom. Warren Buffett said, "Risk comes from not knowing what you're doing. Now you know the risk. The risk is not just losing money fast. The risk is losing power slowly. The risk is confusing a bank balance with financial progress. The risk is letting inflation eat your future while you call it discipline. The bank may protect your balance. It will not protect your future. So if this video made you realize your money is not sleeping, but slowly dying in silence, do not ignore that feeling. Comment "inflation trap" below if you can see the system now. Subscribe to $1 Million Operator for weekly documentaries on wealth, money systems, and the hidden rules designed to keep ordinary people financially weak. Because once you see the trap, you are no longer innocent. You are responsible for escaping it. This was Why Your Money is Dying in the Bank, the Inflation Trap.